Folks, you don't want to miss the smart money signal. I'm talking about some of the world's greatest investors, some of the world's greatest hedge funds, the billionaires, the folks who have compounded at very high rates for long terms, because right now they're sending an important signal for you, and I don't want you to miss it. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So what I'm talking about is you have the quarterly updates. Each quarter, where investors typically manage over $100 million are required to say, hey, these are my U.S. holdings. Let's go through that because some of the greatest investors are sending a signal and a lot of folks are missing the forest from the trees. Let's talk about Warren Buffett managing a $300 billion portfolio. Well, some folks might point to Taiwan Semiconductor and say, ooh, let's look at that. $4 billion purchase, probably done by one of his lieutenants, not necessarily Warren Buffett himself. What I'd argue is more interesting is the continued purchases of two oil stocks. This, in my opinion, is very interesting because this, when you look at these two different oil stocks, led by Chevron, that is now combined his second largest bet. And so this is effectively a call on oil. Effectively, Warren Buffett saying oil prices are here to stay higher for longer. Looking at the data points, looking at supply changes with oil, it does look like there is the risk if the global economy runs hot that you could even have a price spike in oil. You're certainly not seeing a surge in oil production. So I'm looking at this and I'm thinking Warren Buffett anticipates higher price for longer and thus buying these oil companies at low multiples to free cash flow. You're talking about 5, 6, 7 times free cash flow could be very compelling. So that's what he's doing. That's my main takeaway looking at that. But I think the bigger signal that folks are missing is that he still has 120 billion plus cash hoard. That relative to his portfolio, 20, 30% in cash, even if you factor out $20 billion, maybe $30 billion for his insurance portfolio, you're still looking at just a monster amount of cash that he would prefer to deploy in compelling bargains. That means he's not seeing bargains that he can easily buy. Look at Stanley Druckenmiller. Look at his portfolio, Duquesne family office he managed. He is arguably one of the greatest investors of all time. 30%, over 30% for 30 years, not a single down year. This is Stanley Druckenmiller. Just incredible. What does he own? What was one of his top ads during the quarter? He bought Eli Lilly. What is Eli Lilly? You're talking about drug manufacturers. You're looking at businesses that are stable even if there's a recession. Okay, so don't get overly caught up. Oh, he bought Amazon. Well, he's been trading around Amazon. He also owns Chevron, trimmed it a bit, but Chevron's also one of the top positions for Warren Buffett. But what's the main signal? The signal here is that he sees tough times ahead. He has scaled back his exposure, his dollar exposure significantly from over $4 billion portfolio size to under $2 billion. Some of that's the portfolio going down, but most of that, I believe, is pulling capital out. David Tepper, another multi-billionaire, one of the greatest hedge fund managers of all time. Look at that. He's just cutting his portfolio across the board. Look at how he's trimmed his portfolio from $7 billion to under $2 billion. He's also saying risk off. Michael Burry just did a video on some of his top positions. Check that out if you want the detailed thoughts behind it. But there's a theme here. He's looking at prisons, which unfortunately benefit if there's tough times ahead. They have not only stable contracts, but if there's higher unemployment, well, what do folks do when they're unemployed? A percentage of them get in trouble and get arrested. Okay, growth for prison companies. And by the way, these prison companies already trade at cheap multiples to free cash flow. That's the main reason why he's interested. So he owns that. He owns cable stocks. That's what he's interested in. He goes, hey, even if you're unemployed, you're still going to need your internet to, submit your job applications. So he's looking for things that will be stable no matter what the economy. And as I've called out before, he's only like 5-10% invested. He's mostly sitting out. Risk off. That is the signal from all these different very successful hedge fund investors. Okay, so how should you apply this to you? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. Look at Jeff Bezos. Add him to the list of billionaires, effectively giving signals. One of his signals is saying, hey, hold off on big purchases like TVs. Take some risk off the table. Just a little bit of risk reduction could make the difference. Batten down the hatches is what he said just last month. I mean, if that's not a signal, I don't know what is. He's trying to warn consumers, look, It might get rough. You might get laid off from your job. Maybe don't go splurge right now. Maybe wait on that big purchase that you were thinking about. And by the way, the data is starting to reinforce this with, unemployment ticked up recently from 3.5 to 3.7. Then look at household debt. Look at it, it says household debt soars at fastest pace in 15 years as credit card usage surges based on the Federal Reserve report, largest nominal quarterly increase since 2007. This is quite a signal, in my opinion. This is not just noise. This is, 2007 was right before the great financial crisis. What you're talking about is consumers saying, oh my gosh, this unexpected bill came in higher than I expected. I don't know how I'm going to pay it. I don't have the cash. I'm going to reach for the thing I shouldn't touch, which is credit card debt. Credit card debt compounds against you to the tune of 20, 30%, a year. It's terrible, even higher in some places. So it's just absolutely awful. And that folks are reaching for it, that is not a sign of a healthy consumer. That is a sign of a last gasp, in my opinion. And then when you start struggling paying for that, that's when it starts really being felt by the economy, by companies' earnings, because then, you have higher delinquencies and default rates. Look at the S&P 500 earnings. Currently trades around 20 times earnings. S&P 500 around 4,000, doing around $200 in earnings. Earnings long-term grow 6, 7, 8%. Long-term, ballpark, 5, 6, 7, 8%. Long-term. It'll wiggle and waggle based on the economy. But you're paying 20 times. If you were to flip that and think of it as an earnings yield, that's the equivalent of like a 4%, 5% yield. That's the way to think about it. 5% yield if you're going to flip that. 1 divided by 25% yield. If you buy treasuries, you're already getting 4 or 5%. That's supposed to be the risk-free rate. So risk-free rate 4 or 5%, or buy the stock market. So this is the signal for all these passive investors where you're getting slightly higher yield. Not really getting a higher yield because, okay, well, the challenge is what happens to earnings during a recession. Where does this actually go? Is it possible that these earnings could come down significantly? And so this really does create the challenge of what investors are paying for effectively here at 20 times earnings. Is they're saying, hey, maybe I get a little bit of multiple expansion. Maybe I get a little bit of growth next year. Maybe the S&P 500 goes back to its all-time high. Maybe I get up to 20% upside. I think looking at that scenario, the downside, effectively the risk reward is skewed to the downside. It's skewed to the idea that earnings multiple could come down. Earnings could also come down. So I think the main takeaway from you is that there's a big red alarm. There's a big signal that investors should be getting. You should be considering. You see, look at all these major, very successful hedge fund managers, successful entrepreneurs, Jeff Bezos, saying take some risk off the table. So I would, and I'm personally doing this too. I called out to my subscribers earlier today. I'm looking through my portfolio saying what isn't nailed down in terms of having just the best risk reward from here. I want companies with strong free cash flow, companies that I'm like, hey, this will do well even if there's a recession. I'm also looking for sometimes weird things, something where it's like, hey, like a couple of months ago, just last month, I bought this weird European stock that, primarily owns a Chinese asset that trades below liquidation value. And I was like, you know what? I think there's a lot of upside in it. Since then, over the last few weeks, it's up like 50%. So you have in this environment, which I'd argue is a much tougher environment, you want to own things that are either secular growers that will either be able to handle the tougher macro environment, which I think we're just starting to see with higher interest rates, or you need to have things that are just incredibly dirt cheap, or both, and might, for example, or you need to have something that benefits from higher interest rates. That's another key thing. Most companies do not benefit from higher interest rates. Most companies are hurt because their debt profile gets hurt because they have to pay more in interest expense. And then their consumers also are going to say, oh, I'm not sure I can pay for this. Whereas if you own, let's say, an insurance company that has a very short-term, insurance bond portfolio, they can benefit tremendously from higher interest rates. And that's, my top position. I call it out to my subscribers at Unrivaled Investing. So which companies do you own? Do you own companies that have adapted to the current environment and will do well in this environment? That's what you want to own. That's what you want to think about, because arguably this is not the risk-on environment that all these billionaire, very successful hedge fund investors are saying. They're saying this is not risk-on. Now, if you disagree, if you think this is risk-on and that I'm missing something, I'd absolutely love to hear it. So leave some comments in the videos in this video below. And thanks so much for watching. If you enjoyed it, please make a point of hitting that subscribe button. Thanks so much.